Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Rob Moise, and it's nice to have you joining us here for Investor Education Month at TD Direct Investing. We've dedicated the entire month of October to helping you build the confidence to invest and trade. And if you're new to investing, there's a decent chance that social media is one of the reasons why you're here with us at all. Because a recent study by the CFA Institute found that nearly a third of Canadian Gen Z investors said social media influencers were a major factor in their decision to start investing. And that's undoubtedly a positive thing, right? I mean, the hardest part is starting often. So that's all well and good, but there are many pitfalls that investors on social media tend to fall into. Things like excessive hype, misinformation, even deliberate disinformation in some cases. So if you're a new investor, you might be wondering, how do I separate the fact from the fiction, the savvy from the silly? Well, one of the sharpest investing personalities on social media is going to help us out. He's going to share some of his best and worst investing commentary that he's seen on social media and some of the lessons that new investors can take from it. So before we dive into that, I just want to quickly highlight some of the features of our broadcast platform here to help you get the most out of your viewing experience. I'm coming to you right now from the video player in our console here. This is where you can adjust audio levels, you can maximize it, you can minimize it, move it around, whatever you need to do to get the best viewing experience you can, this is the place to do it. We've got some fantastic resources lined up for you here on the left side of your screen. We have links to our guest social media pages, and we also have links to some related episodes of Inside Investing that relate to today's topic, so you might find those interesting. Make sure to check those out. Like I mentioned, this is social media here that we're talking about today. We're on social media, TD Direct Investing. You can check out our YouTube channel, and you can check us out on Instagram. Get some sneak peeks on content that's coming up. Get caught up on old content that might be relevant to you. There are links on the side of your screen right there. My favorite part of the conversation today is that it's a two-way conversation in the sense that we want to hear what you want to know more about too. You can submit questions in the question and comments box on the right side of your screen. And if you're joining us on our YouTube live stream, welcome. And if you want to get your question in, you can check out the link in the description. You can hop over to this platform. You can get your question answered. We want to hear from you too, so make sure you do that. Lastly, we have a lot of events in Investor Education Month and also coming up. This is a weekly show that we do here. So if you look at the center bottom of your screen there in the upcoming events section, you can see some of the upcoming events that we have. If something catches your fancy, give it a click, register, and we hope to see you in another episode. But with all that out of the way, let's get our conversation going and bring our guest speaker in here. Joining us is Richard Coffin, founder of the Plain Bagel on YouTube. He is one of the most popular and well-respected influencers on investing topics with nearly 1 million subscribers to his channel. And he's also an investment analyst by trade, so he brings that dual perspective of influencer and industry professional. Richard, real pleasure to have you on the program. I've been chasing you for a while. I know you're in high demand. I appreciate you making the time for us.
Oh, my pleasure. Yeah, thank you for having me on. And excited to be part of the month of investor education.
Yeah, it's a real treat here to have you with us. And like I said, you bring that unique perspective on kind of how social media content influences not just the individual investor, but also kind of the industry at large as a content creator yourself, but also an industry professional. So what would you say makes social media influencers such an appealing source of information, particularly for young investors?
Yeah, I think with social media, there's kind of two driving sort of forces at play. And one is accessibility within traditional finance, right? Like I think when it comes to how you would traditionally get financial advice, it's either going to an advisor at a bank branch or some other investment firm. And there's a few sort of barriers that come with that. There's the fee associated with it. Sometimes there's a capital requirement. So you actually have to have a certain amount of money to actually start working with certain advisors in the industry. If it's a fee-based planner, there's just an upfront fee you have to pay. And I think sort of unfortunately, another aspect of it is that with traditional financiers, some of this mistrust of the industry based off of that really started in 2008 with the financial crisis. And you still see remnants of that today, both in Canada and the US. So I think it's sort of a combination of those factors have in some ways pushed some people towards social media. And there's also a lot of sort of appealing aspects to getting your information from social media without necessarily talking about the quality of information, which we'll touch on. But it's easily accessible. You think of YouTube and all these social media platforms, free to use. You can use it anytime you want. So that the time of access for this information is really on demand. And related to or compared rather to a meeting with a financial advisor, it's a lot more enjoyable. The process of learning finances through social media, these people are often engaging. They're often viewed as being trustworthy or relatable. And that makes it more enjoyable than going to a branch or the like to sit down and talk about your finances. So it's sort of a combination of those things where if you're kind of putting the quality of information, if you touch on that later, it's easy to see why so many people have moved towards social media for getting financial education.
Mm-hmm. Yeah, I mean, the accessibility obviously is a huge thing. And also, I guess if you want to call it the real people factor, people that are often like you are investing or trading or what have you. So there's the relatability aspect there too. I could see that as well. Now, you're kind of widely regarded as, a credible source of investing information on YouTube, but that's not necessarily the case with all the influencers out there. In your opinion, would you say that the impact or the influence of social media influencers has generally been a positive or a negative thing, particularly on new investors?
It's tough to make a blanket judgment just because you really do have a lot of variability in the types of content you have out there. I do think generally it's had a net benefit in the sense of improving access to information. And I think with most industries where we've seen that, we've seen sort of this net benefit over time. So that means financial literacy has seen an improvement. The understanding of the basics has seen an improvement. And for Canadians, for example, finding out the basics of a TFSA, just to put an idea out there, has become much simpler and easier to access than it might have been in the past. And I think that's all fine and dandy and really helpful. The issue comes with kind of the far end and in some cases more extreme situations where you have either misinformation, poor quality information that might not be backed by expertise or is otherwise just being speculative in nature. On top of the fact that, sadly, we've seen a lot of people take advantage of the trust they've built with their audience. And we've seen the proliferation of scams, sketchy cryptocurrency projects, and other investment sort of marketing tactics that are used to basically draw money from their audience. So I think on the net, we have seen the benefit. And that's kind of the tricky thing is how do you maintain the benefit of freely sharing information without letting this sort of misinformation fester. And I think it's an issue that you see in investments as well as practically every other industry that's seen a similar trend, whether it be politics, even medical advice. You face kind of those similar issues.
Yeah, it feels like it's like the question of our time in the internet era here.
Yeah.
But you've managed to grow a very large following on social media, kind of without, dabbling in some of those, if not nefarious, a little bit greasy tactics and clickbait content and all kinds of stuff like that. What's the secret to your success? Like, what do you attribute it to?
You know what? I would, and I'd love to pretend like it was just amazing content. I think actually my first few videos were incredibly boring and poor quality in nature, but I think a lot of it really was timing. I appreciate that I have put a lot of work into the channel, but I did pick a pretty near impeccable time to start posting content. It would have been about 8 years ago, I think, that I started. And since then, we had the surge of cryptocurrency. Well, we had kind of Bitcoin come to prominence early on. And then after that sort of corrected downwards, we had the pandemic and then a sort of resurgence of cryptocurrencies and NFTs and all these other projects. And of course, GameStop and the rise of meme stocks. And so I think I had this kind of one benefit of timing, and the other benefit where there's not many people who have. So I'm actually registered as a portfolio manager with the Ontario Securities Commission, and there's not many people who are have the flexibility to post content online while having a registration like that. I work for a firm that's allowed me to have that online presence and has been very respectful of sort of the independence I try to foster there. But the fact of the matter is, because there's so much risk involved with discussing financial information and that risk of sort of bleeding into the financial advice category, which is a regulated thing that if you provide financial advice online, you can get into legal trouble. A lot of firms just sort of give a blanket, no, like we're not going to allow, if you're registered, you're not allowed to go online and sort of have the social media presence. So I'm very lucky in that regard. And I think it's kind of just a combination of those two things, the timing and having this background in finance and really filling this void that there wasn't too much of a presence in.
I think that's incredibly modest of you. What I will say is that you got to be good to be lucky, right, Richard? You're obviously doing
Well, thank
something
you.
right
I
here.
appreciate that.
I want to get to know your thoughts on social media a little bit more, and there's so much we could touch on. So we're going to do it lightning round style here. I'm gonna ask you a few short questions and share your take in as few words as possible. Sound good?
Okay. Yeah, sounds good.
All right. So first question up: who's your favorite social media influencer for investing content?
You know what? I don't watch too much content on finance specifically, but I really like Patrick Boyle. He's someone who I've done some collaborations with in the past, and he's a ex hedge fund manager who I think currently is a university professor who talks about finance as well. Although I do also want to highlight, there's a channel called Good Work. It's actually run by Morning Brew, the newsletter, and the guy who runs that, really funny guy. So it's kind of a layman's explanation of all these financial stories and even concepts at times. And I think they're both funny in their own way, and they're both a humorous way to enjoy finance.
I'm also a subscriber to Patrick Boyle's YouTube channel, and his dry wit is just so good.
Yeah.
So check it out if you haven't already. Okay, next question. What's the best social media platform for investing content in your opinion?
I mean, it's biased, but I'll say YouTube. It's the only one I've kind of really looked to explore, and it's just because it allows more longer form content. So, I think TikTok is also really popular for finance content, and it's great for tidbits, but I like having kind of the lengthier explanations.
What about this idea of news, more subscribers making a social media influencer more credible? You think that's true or false?
Oh, no, absolutely not. Outside the issue of genuine subscribers, we have seen accounts, for example, where there's been allegations of purchasing subscribers and the like. So even just outside of that, what's popular on social media isn't necessarily what's good information or advice. So I would definitely, same goes with views. I think views can, they gauge interest in a topic, but not necessarily whether the topic is of inherent value.
Here's a spicy one. Is it ever a good idea to get investment recommendations from a social influencer?
No, I mean, generally not. Like if you say investment recommendations in the sense of stock picks and the like very practical tips that are being provided that you can go and implement directly, I'd say no. And the reason being that, at the end of the day, any financial advice you're getting online or any financial advice you get needs to be personalized to some degree. So you just cannot have personalized financial advice from an influencer online. And because of that, you really can't just take whatever they say at face value and implement it.
And speaking of what they say, one of the things we often hear influencers say is the disclaimer, this is not financial advice, even if what they do right after that is provide some form of financial advice. But do you feel that disclaimer is enough of a warning to investors not to act on information that an influencer provides, or does there need to be more to it?
No, and I think that's kind of I don't think that disclaimer even really holds any legal weight. Like, I think if you say I'm not going to do this and then proceed to do it, that disclaimer is from a legal standpoint doesn't hold a lot of weight. It's just that, some people started doing it to check their boxes, and I think legally any department would advise you to make that statement regardless. And so it's kind of just become this common trend to do. But I think if you aren't going to give financial advice, I think you should proceed to not give financial advice and, discuss which stocks to be buying and things like that. And I think, that CFA report you mentioned earlier, I think in there they describe more extensive disclaimers as being one of the possible solutions for tackling misinformation, to disclose not just, your intentions with financial advice, but the positions you hold and the like. And I think that's where you need more attention given.
Yeah, actually, a really interesting factoid out of that CFA Institute report was that they studied a bunch of content that was put out by social media influencers. Only 25% of the content created actually had the appropriate disclosures around some kind of conflict of interest, like the person that held the stock or what have you. Really telling stuff, and it makes you want to take what some of these folks say with a grain of salt. Anyway,
sure.
we forge ahead with our lightning round here. A lot of influencers, they'll offer some kind of paid education course for investing or trading, what have you. Generally speaking, are those worthwhile?
It depends on what your objective is. I think, broadly, I would say you should be incredibly skeptical. I wouldn't want to give a blanket judgment, but I would say there's usually other alternatives out there. And I think the unfortunate thing with creator courses is they're often quite pricey. So that alone, I think there's other things worth exploring. I know McGill University, for example, has a free online personal finance course. So I say explore all the free resources, look into books that are available. And, you could spend under $100 and end up with the same education or level of education as a creator of a course. But, if you like a influencer and you like how they describe stuff and you think it's worth it just to learn, that's great. But if you want to analyze stocks or do something more kind of professional, I don't think there's going to be many courses that justify the price tag you're paying if it's coming from a creator who doesn't have that sort of expert background.
Mm-hmm. And shameless plug, I'd be remiss if I didn't mention that TD Direct Investing, this is all free educational content we have for you here. So make sure to check out all the stuff that we have here, master classes, video lessons, other, webcasts like this. Check them out. My last one, my favorite part of the lightning round here, Richard. You recently rented a McLaren sports car for a video that kind of spoofed the stereotypical rich influencer lifestyle kind of stuff. I took a few outtakes of that. I just want to show people that because it's great stuff. Let's check it out.
Thank
Richard,
you for clipping that.
Looking incredibly fly, I have to say. I don't think anybody could argue with that. But in your opinion, when people see wealth flexes like this from social influencers, is that generally a red flag that, they may not be credible, they're trying to sell you something?
Yeah, I'd say so. I mean, I think the only time you typically see that sort of level of approach is when they're trying to substitute other merits of their information with sort of this glitzy and glamorous wealth. Because I think what they're trying to do is they're trying to access that sort of shortcut heuristic that we have in our brain of, well, this person has wealth or is pictured next to wealth, therefore they must have been good at investing to get to that position. And they're trying to take advantage of that very simple connection when, I don't drive a McLaren. I have a used Mazda 2012. So it's just, I kind of did that as an example to demonstrate it's very easy to fake that level of wealth online. So I think if you see someone who makes a note to show that kind of stuff, you should definitely proceed with caution, especially if there's something trying to be sold to you.
Okay, so watch out for 5 Rolexes on the person's wrist or something like that.
Yeah,
that could be a red flag. Just quickly, how fast did you end up driving that car before you returned it?
Oh God, I barely touched it. I was so so nervous. And the guy, I think he gave me a lot of flexibility to drive it a bit. We were in a parking lot filming, and I drove it for that very small stretch of the car rolling forward. But I think I must have driven 10 meters. And then I was like, that's, just the there was a fear that if I pressed the wrong button or hit the pedal too fast, I'd be on the hook for a pretty expensive car bill.
Yeah, right. We want to rent a McLaren, not necessarily own one here. Okay,
That's right,
great stuff. Really fun. Thanks for playing along. Now, I just want to get some of your thoughts on the social media landscape and some of the things that new investors might want to look out for here. And one of them, like we mentioned, is that subscriber count isn't necessarily a good gauge of credibility for an influencer. So what would you say that they can do to try to gauge the credibility and trustworthiness of an influencer and their thoughts on a specific topic?
I'm going to piggyback off of that CFA report again, because one thing I really liked is they did a really good job of not only tackling or demonstrating how the issue currently exists, but also some possible solutions or suggestions for tackling it. And there's one section in that report where they talk about how to do just that, how to assess information that's provided online. And I believe the 3 factors, the first one is to consider motivation. So what's the motivation for the person sharing the information online? Are they doing it for fun, to build an audience, to market a course? Are they trying to sell, whether it be a cryptocurrency project or something along those lines? When you get a better idea of the conflicts of interest that exist, you can kind of better assess the trustworthiness of the person talking to you. So that's one aspect. The other is, of course, qualifications. And I say here, with qualifications, I think there's room for finance when it comes to let's call it someone giving their personal experience with finances, even if they don't work as a professional. You have to assess the expertise that would be required for the information being provided. If someone's saying this is my experience budgeting and even with investing, I think that's great. And I think it increases sort of, again, that accessibility and visibility on what investing might look like. So I think there's still value there. But when someone starts to give stock picks and the like, or even just investment philosophies and things of that sort, you really need to consider their qualifications. And whether you can verify those qualifications, which is important. I think on social media, you see a lot of examples of really young individuals saying, at my ex hedge fund that I was running or whatever. And if you can't verify those details, I think you should just ignore those, assume it's not a real qualification. So qualifications, of course, being an important one. Do they have experience in the field or with investing? That's easy to truly verify. And the third being consistency is what they labeled it in the report. But basically, is the information they're sharing consistent with other sources? So if they're talking about the basics of a topic, is that something you can go and verify at a different website? Or does it conflict with common other sources that you can come across? And, it's not perfect. I think there does still come a bit of a judgment call with any source that you look at. But I think that at least gives a bit of a framework so that you aren't going in completely blind when trying to assess different characters online.
I was feeling really unaccomplished there when these 19-year-old day traders were telling me that I don't have my own hedge fund yet, but it sounds
Likewise,
like I don't have to feel that anymore. Well, actually, one of the things that you mentioned consistency there, that's actually something that we heard from some of the social media influencers that we spoke earlier this month. They would also mention the importance of consistency of message across time. Mm-hmm. If somebody's constantly changing their views, they're probably not really that sure of that view, and they might just be chasing views. So if you want to check out that conversation, guys, you can check out the resources section. There's a link to it right there. Title starts with social media stars. You should be able to see it right there. Anyway, let's move along here. One of the things that we get inundated with on social media is clickbait titles, alarmist thumbnails. You've actually used this jokingly, some of these tactics on one of your videos as a nod to how effective they can be, especially with the way that the algorithms work. How might this kind of sensationalized content influence somebody's perspective, even if they're aware that what they're looking at is kind of clickbaity?
Yeah, I think, and that's an important question, because I think people see clickbait thumbnails and the like, and they kind of recognize, well, this is just how the game works. And if you want to be noticed on the algorithm, you kind of have to play this game. And, I think there's a bit of grace to be given there to an extent. But I do also think that there is a somewhat of a negative impact that you can have. When someone, for example, is trying to assess the economic environment that they're investing within, if your algorithm is sort of spewing out video after video with this intense negative bias on it, I think subjectively that's going to impact your view on markets, on investing. And, especially when many of these videos have in the past strayed so far into clickbait as I've sold everything, markets are going to crash 2025, those sort of snippets. Even if you recognize that they're just playing a game, there's something that might register internally when you kind of try to assess, well, how do the markets feel right now? I think can also contribute, we have sort of behavioral biases or instincts that can be sort of swayed by these sort of smaller factors. There's something called herding, where you're more comfortable following the actions of others because it feels less like you're independently making your decision by yourself and alone. And I think that can contribute to that sense, that if you see all the influencers you're following sort of peddling these negative stories or headlines, it can give you, again, this sort of sense that of doom, of some sort of coming correction and the like. So, I do always add the caveat that you do have to assess a creator's content in addition to their thumbnail. So it is also important what they actually say in the video. I don't think anyone genuinely goes out and tries to base their investment decisions off of what their thumbnails look like. But I do think you have to consider that the thumbnail is part of a creator's content. So you have to consider that in assessing their information, and that it likely does have some impact sort of subconsciously on what someone on their decision-making process.
So what could we do to help kind of minimize that influence on us? Are there any best practices you have in mind?
A lot of it really, unfortunately, comes down to self-moderation, because the algorithm, if you click on something, if you watch sort of those videos, it's just going to feed you more of it. And what we have seen with the algorithm is that those alarmist thumbnails perform really well. The reason why we see so many is because the creators incentivize it. They want to be successful. If they want to get eyeballs, they play that game, and that draws in a lot more traction. It's a lot easier to build an audience or get views that way. So a lot of it comes down to self-regulation, recognizing when your feed is sort of full of this information, trying as best you can as to train your algorithm personally, because if you avoid clicking on these videos, you're less likely to be fed them. But then also just evaluating the information they give you to determine, again, the trustworthiness of the creator. And if you go to make an investment decision, I think it's handy, and I don't know how many people would go through this step, but I think it's worthwhile to, if it's sort of this gut feeling sense or emotional sense driving this decision, to write down what sources you have for making this decision. Because I think while you might not attribute your feeling of concern over the market to these thumbnails, I think that might be what's giving you that sort of sense of this coming correction. And if you are forced to list out your causes, either you'll end up with a really small sheet, after which, great, you don't have much of a you don't have much support for your decision to make this gut feeling reaction, or you're going to have to list out these sources, at which point you can probably assess, well, maybe I shouldn't be investing my portfolio based on what I see on social media.
Mm-hmm. Okay, that's a great little handy tactic to use. So thanks for sharing that. And one of the things I really wanted to pick your brain on is what we could perhaps describe as cult-like behavior around some of these meme stocks that are out there. I'm thinking of GameStop. I'm thinking of Bed Bath & Beyond. We see it a lot in cryptocurrencies as well. And for a new investor, this can be really difficult to navigate, because you might see influencers and their followers, they're sharing research, and it posits some grand conspiracy theory type kind of thing that supports their investment. And it can sound really convincing to someone who isn't necessarily a sophisticated investment researcher, and even though this research that they're putting out there is complete nonsense. So how can you avoid falling into these rabbit holes that can be really easy to get sucked into and hard to get out of?
It is tough, because even to your point about the sophistication of some of these sort of theories, they get quite impressive. When people have enough time on their hands, they come up with pretty extravagant speculations about where stock is going to go, or what's being done behind the scenes with these positions. And I think, unfortunately, a lot of it is sort of hard to prove or disprove one way or the other. And it's in that gray area that a lot of these communities thrive, because you can't prove it, and confirm it, so it doesn't become mainstream. And you can't disprove it, so it's allowed to exist. I think in terms of how to avoid falling into those rabbit holes, on the one hand, it goes back to, a lot of these posts, they talk about, say, doing your own research. And I think if you take that genuinely, if you actually apply that, you wouldn't end up down a lot of these rabbit holes, because a lot of it really does rely on the speculations of others. Where someone will say, well, I've seen this sort of trading volume in this dark pool, and that reflects so-and-so buying this position, and that means it's about to skyrocket in value, which sounds very sophisticated. But if you aren't able to verify those claims, if you aren't at a level where you can do that type of research or understand it, I don't believe you should be investing based off of it, because in that way, you're giving your trust, in many cases, to an anonymous individual. A lot of these communities, they thrive off of what's essentially anonymous research. And I think it's great to an extent to have communities who ask questions and explore answers and try to come up with arguments around it. But a lot of the issues with these stocks is that they go that step further of saying, therefore, you should buy this stock, or therefore this stock's going to take off, rather than therefore we should explore this sort of unknown box that we've come across and ask professionals who are familiar with it and the like. And I think if you, have the sense that you want to invest in something, I'd say, ask around, talk to professionals in the space. If you have questions about complex market structures, I say dive into it, try to educate yourself, but don't make an investment decision until you understand these market factors. And until, again, if you have to write down on a piece of paper what your sources are, until Reddit isn't one of the biggest sources of your decision there.
Yeah, I think I always go back to the quote, incredible claims or extraordinary claims require extraordinary evidence. And if you can't point to something like that, that's kind of the litmus test for me, at least. It's a fascinating talk. Oh, sorry, go ahead. Yeah, go ahead.
Yeah, so I was just going to say, I think a lot of it, to your point, it's a lot of speculation. I think you need to identify when someone is speculating on something, which means sort of guessing or drawing a conclusion that isn't necessarily backed by evidence, and when there is something that's concrete. I think a lot of people, for example, with GameStop, there's always this discussion that hedge funds are collaborating to short the stock out of existence effectively. but we never really had that concrete evidence, whether it be a short share float or any real evidence of collaboration in the space. So I think, while that claim, it's certainly possible. There's always this possibility that something's happening in the market that we aren't aware of. But to your point, that's exactly it. You need extraordinary claims to back you need extraordinary evidence to back extraordinary claims. And if you're basing your investment strategy off of an extraordinary claim, you best make sure of that.
You made a cameo in a fantastic documentary series that came out by a YouTuber named James Janney. So if anybody wants to check out Richard's cameo in that and the perspective that he shared on the whole GameStop, Bed Bath & Beyond saga, if you want to call it that, check it out on YouTube. It's really worth a search. A fantastic watch. I really enjoyed it. And that whole situation actually brings up the question of due diligence or doing your own research. We often hear influencers talk about this. But the reality of it is that most people kind of suck at doing investment research, right? It's difficult to do. So as someone who's in the industry, what would you say that high quality due diligence, doing your own research actually looks like?
Well, I'll start off by saying I don't think most people should do stock picking sort of style research. And by most, I mean that most of the population, not most of the people who are interested in investing, because if you have that passion and that interest, absolutely go for it. But this idea that everyone should be a stock picker, I don't think makes a lot of sense when you encompass sort of people of all degrees of expertise in the space. If you have the interest and the time to do it, absolutely, I say explore it and look into it. But you don't have to stock pick and the like to be a successful investor. So that's the first thing to highlight. The second thing is that if you decide to do stock research and the like, as you're kind of alluding to, there is quite a process behind it. I have a full-time job. Part of that is portfolio management, but I also still do a good amount of research. And it's a process that takes workday after workday at times. And in terms of what it looks like, it's not just reading through the filings, but analyzing the financial information, the statements, the KPIs of the company, understanding what they do qualitatively, which I think is something that a lot of people, they assume they can kind of boil down a company to a few numeric stats. And certainly that's helpful, and that's an important part of financial analysis, but also just understanding qualitatively how the company sits in their ecosystem of competitors, of regulation, of the industry as a whole. And in addition to that, looking at kind of repeating some of the process for nearby competitors, because you want to make sure you're picking the best company that in the area they're operating. So there's all this aspects, kind of this research phase, and then there's also the valuation phase, which I think a lot of people find really difficult. And it truly is one of the most difficult aspects of investing is taking the stock price of a company and saying, do I think this is higher or lower than what the stock is actually worth? And you can get really extensive with the valuation process, doing a full discounted cash flow or things of that sort. And, if you aren't comfortable with those kind of aspects of research, I think you should take some time to explore that and take the education you need and practice before you start selecting stocks. I think accounting is an area, for example, that I think a lot of people hop into investing before they really understand accounting, whether it be financial statements, understanding the difference between earnings and cash flows and free cash flow and the like, knowing the drawbacks of things like EBITDA and all these terms. And I think if you don't have that background in accounting, I think that's also kind of a bit of not background, but if you don't have that education to understand financial statements and the like, I think you need to take more time. It should be a good litmus test that if you don't, understand what depreciation is, if you don't know EBITDA versus net income versus free cash flow, there's some steps to take before you dive into the world of stock picking.
Yeah, it's certainly a process rather than a moment in time, and you're going to find that your abilities constantly improve over time, provided that you're diligent and trying to upskill. Mentioning the accounting principles there, you're making my dad smile. He's an accountant, and he's always talking about the virtues of accounting. There you go, Dad. You got one for you. Anyway, so fantastic stuff, Richard. Thanks for sharing all that perspective on sort of the social media landscape. Now, let's get to the heart of the matter, the best and worst investment commentary that you've seen on social media here, and what you think that investors can learn from it. So I want to start on a high note, and you mentioned it before, Patrick Boyle. This one comes from YouTuber Patrick Boyle, and he suggests that investors stick to investments and investing styles that fit their risk tolerance rather than trying to chase the latest investment trend, even if it's done really well. Why do you think that that's such an important piece of information for investors to take to heart?
I think it's important. And I think part of it too, it also extends, he was discussing even the behavioral side of it, like aligning your investment strategy with how you behaviorally are interested in investing, or the types of companies that you enjoy investing in. And I think part of it is that behavioral aspect, where the better you can align your strategy for investing with your behavioral strengths and or at times just acknowledging your behavioral limitations and weaknesses, the more likely you are to stick to that investment strategy through times thick and thin. So as an example, if you are someone who is more conservative with your investing style, you like holding sort of blue chip or long-term performing investments, but you hear about growth stocks and you hear about these positions that are say trending in the news, and you say, well, geez, I should probably put some money in there. The first time that company, even if you made a good investment decision in the long term, the first time that company hits a hiccup, it's going to be much harder behaviorally to stick with that investment through a long-term period if it doesn't align with your own views around investing. So it's a bit of a unique approach with investing, but I think there's truth to it. And it kind of talks to, there's always this debate about value investing versus growth investing versus passive versus active. But I think there's a very strong case to argue there from a behavioral standpoint, that if you can align your your investment strategy with your behavior and your interest and the like, I think that can be a very strong force.
Yeah, sometimes you have to kind of get out of your own way, so to speak, and just kind of pick a style and run with it. Yeah. There's a lot of value in that. One of the things that we heard earlier this month too from Andrew Hallam, who's author of Millionaire Teacher, I'm sure you know him. He talked about the power of the consistency of investing steadily over time can do so much work. You don't necessarily need to be a brilliant stock picker, the next Warren Buffett or something like that, to do well at investing necessarily. Okay, let's switch gears here. I want to talk about one of the worst bits of investing commentary you've heard on social media. And this one is investing in stocks because they recently had a positive news headline written about them, or something positive happened to them, that investors clued in on. This one is really popular on TikTok because it's really easy to create like a snappy little video. Why is it not that easy?
Yeah, and to your point, I think 2021 was probably when we saw a surge of these types of videos specifically. But in terms of why it's not that easy, the one thing to keep in mind with news items, specifically around the stock market, is that it's incredibly difficult to buy a position before that news information is baked into the stock's price. So even if that news article is referencing something that will happen in the future, when it's first announced, the market is very quick to adjust the price to reflect that, because you have to keep in mind that stock prices are forward-looking. So when you go into the market to buy a stock, the seller is just as informed on what's just happened with the news articles as you are. So you have to keep in mind that they're going to sell you at a price that reflects that news item. Otherwise, you found a way to arbitrage a free profit effectively and make a free return. But with a lot of the stock market, a good chunk of volume comes from market makers and large institutions that are to the millisecond adjusting stock prices to reflect news headlines. And we talk a lot about AI these days, but AI existed well before generative AI and was used quite a bit in the finance industry to quickly analyze headlines and adjust prices accordingly. And we've had things like high frequency trading, where you see, again, trading on a nanosecond scale, I think it's called. I might be mixing up my units there. I'm not too familiar with the nomenclature, but with headlines, it's worth considering that really the moment a headline comes out, you see the stock price adjust, and that's reflecting the seller's best estimation of how that impacts the stock's price. So if you then take that and say, well, I'm going to buy because I think this was positive news, now you're just buying the stock at a higher price based on something that's already baked in, assuming that you're going to get an excess return from it. And to an extent, that's not to say the stock might not do well, but you are effectively just buying something off of a moot point effectively.
Somebody, I don't want to get too inside baseball here, but somebody in a previous episode that we did asked a really interesting question about whether is the market still efficient, the efficient market hypothesis, particularly in the age of social media, when things can be very hype driven and we can see insane spikes in stock prices or plummets, frankly. What do you think about that idea of the market being relatively efficient at pricing stocks? Is that still a thing, or has that changed to some degree?
I think it's relatively, I think it's still a thing. I think you can have short-term periods of departures from market price efficiency. I think GameStop reflects a pretty good example of that. And you could argue that that is related to short squeeze interests and the like. But I think GameStop was an example where when it was at the peak price, a lot of people were arguing this is not an efficient price for this company. It really does not truly reflect the fundamental value. And I think it'd be hard to argue otherwise. That being said, that doesn't necessarily make it easier for individuals to identify when the market's being inefficient. So even though it's fine and dandy to say, yep, the market is not going to be efficient all the time, it's tricky to know how long an inefficiency can last for, and to have the ability to identify inefficiencies and take advantage of them. So I think it's always safe to assume the markets are, for the most part, efficient. And I think if we see a true departure, eventually that gets corrected over time. I think certainly you can have short-term periods of inefficiency, as you would expect. It's very difficult to have sort of this perfect pricing mechanism. And especially, situations like GameStop, for example, I think there was an SEC report that came out after the fact that actually demonstrated that short sellers during the short squeeze exited the position, and that helped contribute to the price. And what helped contribute to the rise price further is that short sellers were no longer willing to bet against the stock, which actually allowed it to sort of surpass this, what otherwise would be its fair valuation, because there was no one applying downwards pressure to correct it, because all these people basically said it's not worth the risk. So I think, again, you can have these periods of inefficiency that exist in the market, but generally better to assume that the market's going to be efficient most of the time.
There is that famous quote that the market can remain basically crazy longer than you can remain solvent.
Yep.
I'm butchering the exact wording, but yeah, like that's something to keep in mind. But okay, I want to move on to another good bit of commentary that you've heard on social media, and it kind of contrasts nicely with what we were kind of talking about picking stocks and stuff like that. And it's that asset allocation and keeping your trading costs down can be some of the more important factors than actually the specific investments that you choose when you talk about your portfolio's performance. And that might sound kind of counterintuitive to some investors. Like, why is that the case?
Yeah, so I think I'm going to forget the name of the report, but I know there's been research done in the past that shows that a lot of market or portfolio volatility is explained by asset allocation rather than stock selection, meaning that the performance you ultimately see over the long term, so not short term, you can have things that are very much based on individual stocks, but over the long term, it's usually just how much money did you invest in the stock market as a whole versus apply in bonds versus even cryptocurrencies and the like. And I think the idea is that over the long term, your returns for that asset group are going to somewhat align or move closer to the mean, effectively, of what the group is performing like. So I think what that means is that more effort should really be focused on getting investing and finding the right allocation based on your risk profile. Then maybe you should, a lot of people will do, say 90% stock research and 10% allocation and sort of appropriateness, when, some research would argue it should be the other way around, focusing mostly on whether it's appropriate and risk tolerance and the like, and then whether it be stock research or just picking more broadly diversified products. And then same thing with fees. Fees, I think, the best way to look at fees are as negative returns. So if you have a 3% fee, well, that's every year that you have to earn more than 3% just to break even and see a positive return. So if you can minimize your fees, that's just free return, for lack of a better word, compared to other alternatives. So I think, again, those two factors provide a very tangible benefit to your return. Whereas stock research, it's a bit harder because we've seen the arguments that the vast majority of mutual funds do not outperform the S&P 500 specifically, but generally speaking, they're benchmarks. And so if it's difficult for professionals to do it, then it makes sense that the better source of, or where to focus your attention, is probably on that former, the allocation, the appropriateness, the risk tolerance, and the like.
Mm-hmm. Yeah, I've actually read that study that you're referencing. It's probably not the most accessible for a new investor, but the takeaway that we just discussed there is quite powerful. And if anybody wants to check out the differences too in the performance of various types of funds, the S&P Global puts out a report, called SPIVA, SPIVA, and you can kind of check how over certain periods of time, mutual fund managers have done compared to like an index, like the S&P 500, for instance, and stuff like that. It's really interesting stuff and can kind of really change your perspective. So we talked about asset allocation there for a bit. So that kind of brings us to another piece of terrible investing commentary. And I'm going to pick on them again, the 19-year-old TikTok millionaire day traders that talk about the idea of you should just be plowing your money into highly speculative assets, be it crypto or something else like that, because you can't get rich off of investing in stocks. And, the interesting thing, Richard, is I've actually heard you say in some of your videos that, you're probably not going to get rich off of investing, probably. So some people might look at that and say, well, Richard, I really want to go to the moon with my next investment. So why are we not getting your permission to launch here?
Yeah, I would give it if I could. But the thing with, I generally agree. And to your point about, probably it won't make you rich. If you view investing as this mechanism for solving all your financial problems, it's going to fall short more than likely. And really those videos, really the objective was to gauge expectations around what investing can do for you, because I think it's a really effective tool that most people should strive to utilize, but it can only do so much. And really what's a driving force, kind of two of the more important factors for driving your performance are time in the market and your savings rate. So how much you're able to put into the market, because those are two very, obviously we all face limitations. If you're starting to learn about investing for the first time and you're maybe approaching retirement, obviously you have more of a limitation on timing and time horizon. But for the most part, those two factors are more tangible and easier to impact or have influence over than the return that you're able to achieve, because those are what are going to affect your financial performance. It's the return you earn on your investments, how much you're saving or actually investing, and how long you're able to have that money invested for, or how long those returns compound. And really, timing is one of the most effective methods, because the longer you have, the more compounding takes into effect, and meaning that basically your returns, even if they're lower, even if they're just plain market returns of somewhere between 7 and 10%, it's going to do a lot of the heavy lifting of growing your investments. So investing can do a lot, and it can really bridge the gap between where you are and where you want to be with your financial goals and the like. But in terms of plowing your money into different investments, on the one hand, there's no predicting the future. The guy who's telling you to put all your money into Bitcoin doesn't know where Bitcoin's going to go next year, no matter how excited they are about the cryptocurrency. And there's really no investment out there that can promise or ensure an outperformance or an excess return. So A, you just have to take those claims very cautiously, and B, again, even with just a plain market return, you can still do incredibly well with investments if you focus on those other two factors. So it's not to say that investing can't put you in a higher tax bracket or really improve your lifestyle, but a lot of, especially kind of the more shady characters who are selling a course or the like, they'll advertise investing or buying Bitcoin as this way to blow up your returns and enter a new lifestyle. And I think, again, talking about biases and the like, that's sort of a representativeness bias. If you see one person make it big with Bitcoin because, they just happen to put $100 in at the right time and now it's worth tens of thousands of dollars, that's not representative of what you're likely to experience. In the same way that if you look at a lottery ticket winner and you say, wow, I should buy a lottery ticket, that's kind of the same mental shortcoming that we're coming to when we see someone make it big with Bitcoin or another investment and decide, you know what, I should now buy because maybe I'll get that same experience.
There is a degree of, survivorship bias here, where you only hear about the stories that work out, right? Yeah, nobody talks about how much they lost in whatever cryptocurrency or investment, whatever it may be.
Yeah.
One thing though we sometimes see videos of on social media is, somebody will post like a screenshot, or they'll show you like a video where, they hold some obscure cryptocurrency or small cap stock or something like that in their trading account, and they have like $1 bajillion in here, and you're like, wow, this person's rich. So it might be hard for a new investor to kind of fight the urge to try to, YOLO, if you will, into these kinds of things. But what does somebody need to understand about those types of videos on social media where somebody shows that they have like all this money in a trading account?
Yeah, the first thing is that it's very easy, again, to fabricate. We've talked about it to an extent, but it's very easy to fabricate returns online, and not just even with just fake accounts and literally fabricating a type of investment. but that person might have multiple accounts. So they're just showing you the best performing account. And again, that survivorship bias to only focus on the best performer and present that as being representative of all the other accounts. I've seen plenty of examples of people cherry picking the returns they show. So I've seen examples where someone shows their account, but they sort by return and they stop once they get to a certain level. So they're only showing the companies that say doubled in price or whatever, and then going down the list until they get to the positions that are zero, but you don't see anything that was super negative, because surely if you're pursuing really speculative positions, you're going to have some really significant losers in that portfolio. So it's worth considering that, again, there's a veil of sort of opaqueness that comes with online information and screenshots and the like. So you have to consider that aspect. And then again, even if you see someone sort of, when you see someone, we call it YOLOing their money into a position, you have to recognize that as the gamble it is. That person might end up turning around and saying, look how successful that was. I made a big sort of return here. But that is effectively gambling, right? And I think it's important to recognize when there's a good decision with a good outcome and a bad decision that still has a good outcome. And you do still have that. Buying a lottery ticket and winning the lottery is still a bad decision that was followed by a good outcome. Statistically, it doesn't make sense to do so, but there is still the possibility that someone ends up with a positive outcome. It doesn't mean that it was a good decision, and certainly not one that most people should replicate.
I just want to mention to our viewers here joining us in the broadcast platform, we have a poll up on screen. We want to pick Richard's brain, get to as many questions as we can. So vote on the question that you want Richard to address. That's up there on the poll here. And we're going to take the top 2 responses. So we want to try to get to as many questions as we can here, Richard. I know we've gone a little bit long with our conversation. Could I be so bold as to steal an extra 10 minutes of you past the hour just so we can get in a few more questions?
Yeah.
Okay, you're excellent. My favorite kind of guest. Thank you. I appreciate that. And while people vote, let's get to a question now from our audience here. And this is from Lorena, and she is asking, is it a waste of time to watch older videos? Like, does the info have to be, same day recent or very recent to be worthwhile?
No, I mean, there's certainly something of value that comes with staying on top of information, and even just when it comes to basics. Here in Canada, we recently got the FHSA account, so the first home buyer savings account, which you wouldn't have heard about 3 years ago. So for purposes like that, even from a personal finance standpoint, there is value in being updated on these topics and kind of trying to keep a pulse and being a continual learner. Even for me, as a professional, I have to learn what an FHSA account is when it's announced, more recently. However, I would say like the vast majority, when you think of broader topics and personal finance basics, general topics generally are true to time and continue to if it's principles based learning, those principles are likely to exist in the future. There's a great book. A lot of people attribute it as like the Bible of value investing. I think Warren Buffett might have given it that title, but The Intelligent Investor is a book written by Ben Graham, who taught Warren Buffett. And, in this book, it talks about styles of investing, but it also talks heavily about putting a good chunk of your money in treasury bonds. When, I was reading this book, I think it would have been 5 years ago, and treasury bonds are paying 1% to 2%. It doesn't make much sense anymore. So it's again, taking kind of the principles that are being taught, but considering the nuances of the practicality of, or again, the sort of, considering the environment that you're currently in relative to the environment that this advice is being given within. So, it's kind of a nuanced, annoying question, or answer, not question. Question was great. Nuanced, annoying answer to the question, but, principles are great and they are, exist well throughout time. And can maintain their quality, but you do have to consider sort of updates to the practicality of some stuff.
Yeah, great question, Lorena. I really like that one as well. We do have another one coming in here. This one is from Kelly. What asset allocation might make sense for a young investor just starting out? What do you think, Richard?
It's, again, to use the page from Finfluencers, not financial advice, but you do have to consider a lot of different factors outside of just age. So that can be how much debt you have, if you have student debts, if you have a credit card balance, what your near-term objectives are. If you're going to be buying a house sometime soon, that can really impact whether you're even able to put any money into the stock market. There is a general rule of thumb that some people will reference, and it's 100 minus your age can reflect sort of a target allocation to the stock market. So if you're 20 years old, that would mean 80% of your portfolio is in the stock market, but that's a very, very rough gauge. So that gives you an idea of how time is an important factor with risk tolerance, but it's not the only factor. So that might help you assess your risk tolerance from a time standpoint, but you really do have to consider all those other things. I don't think there's any sort of one and done rule when it comes to age-based financial advice. I will say that the reason why you have generally a higher risk tolerance, all else held constant when you're younger, is because you have more time in the market to, well, I mean, the main thing is that you have more time in the market to recover through downturns. So over the long term, we've seen that markets, they fluctuate up and down. And you don't want to really invest in a short period of time, say 2 years in the stock market, because there's a good chance that if you buy here, there's a possibility that you sell lower, and you don't want to risk that if you have, say, a house payment that's due in 2 years. However, if you're young and you're, say, saving for retirement, well, that's, call it a 40-year stretch or a 30-year stretch that you can leave that money in the market to recover, and assuming you're doing prudent investment management. So that's kind of why age is generally considered to have this inverse relationship with risk tolerance. But again, a lot of other factors to consider.
Yeah, what's the saying? Personal finance is personal, so there's no one size fits all. But really, it's kind of depends on what your goals are, and there can be different timeframes and types of investments that you do for different goals too, right? It's not like necessarily just one thing. Okay, let's get to the answers on our poll, and let's see what our audience wants to know more about here. So let's cue that up here. It looks like pretty overall, almost half the people here are asking, what's your favorite episode that you've done on your channel and why? Good question.
That's a good question. You know, I used to do 5-minute history lessons that were fully animated, and they were a lot of work. And I kind of finished doing them when I started having kids because I just ran out of time. I didn't have time to do them anymore. Those were a lot of fun though, because it was, and I'd say whether it be probably the last one I did, which was the South Sea Bubble, is one of my worst performing videos, funny enough. But I really enjoyed that one. It was on a more sort of obscure topic, or event rather, because I think it was the 1700s that it occurred. But those are fun because it's sort of just flexing the creative side of the channel, making animations and the like, which I don't do a whole lot of anymore, mostly from a scheduling, because of scheduling. But that was a really fun one. But I would also say that the Finfluencer one, where I referenced the CFA report and I got to rent the McLaren, that was also a lot of fun to do as well. I really enjoyed that one.
Yeah, I think my personal favorite was your one on Finfluencers. That one was like really well done and really thoughtful. So I encourage people to check that out. Yeah, it's really well done. There's also another one that you did on the impact of influencer marketing, which I thought was like really smart. Something that I think people don't necessarily think of, but it can have a big impact on the types of information that people are putting out there into the world that bears considering. Okay, without further ado, the second most popular choice on our poll here I'm looking at. Should I only pay attention to influencers who don't have sponsorships with financial products and services?
Should you only listen to people who don't? You know, it's tough to say. I don't want to make a judgment call for the whole industry. I would say you do have to add a layer of skepticism when you see that regarding what information is being shared, right? If you have, and I've seen this, for example, and I think I might have highlighted this in the Finfluencer video, you can have videos that are top 5 brokerage platforms sponsored by a brokerage platform, and you know, shockingly, who takes the #1 spot? You know, so there's certainly a consideration there, and I think maybe that plays a role in how you evaluate that creator across all their videos, if they're sort of taking those deals and maybe obscuring their information a little bit based on where they're being paid. But should you only listen to people who don't? I don't necessarily know if I'd say that. I just think you have to add that layer of skepticism and be careful and consider what type of sponsorships they're taking. For example, if someone's taking a sponsorship to promote a specific stock ticker, which we've actually seen examples of, someone saying, hey, this video is brought to you by ticker XYZ, an oil and gas exploration company. I think you should be cautious of that, because I think that does reflect poorly if someone presents themselves as, say, a stock picker or the like. If they can effectively have their views paid for, I think that's something you should be critical of. but I'd leave room for that judgment to be made, and rather than making a blanket judgment. It really does depend. And I think someone shouldn't be, I don't think you necessarily need to ignore people who say take a sponsorship from a brokerage platform. You just have to consider, well, how might that impact the information they're sharing with me? And are they appreciating that as creators, or do they sort of, blur that line between their genuine content and their sponsored information?
Yeah, just a reminder to those in the audience, if you're watching on YouTube live and you want to get a question into Richard here, just follow that link in the description and you can hop over here and fire your questions away. I think that's a really good point that you make, Richard. So, but I want to keep the train rolling here. I don't want to interject every single time here. Let's go to another question here. This one's coming to us from Joseph. Joseph says, what material does Richard regularly read and learn from to get insight?
I've read a lot of news articles and a lot of newsletters, sorry. And, speaking of sponsorships and the like, there's one that I was sponsored from after reading for many years, so I feel the need to highlight that. But Morning Brew is one that I really enjoy. I read the Daily Upside as well, who's partnered with the channel, and one that hasn't partnered with the channel before. The Economist is I subscribe to their service, and I quite like their newsletter. Espresso, I think is what it's called. So I read those on the daily. And that's mostly for information, keeping a pulse on things, and as well as many other websites as well. Bloomberg being in Bloomberg as well. So that's more for the news information. There are also some, we get a lot of, and this is where, because I work for the company, there are certain aspects I can't disclose per se, but there are also research providers that we have access to at my company. So in a way, I do benefit from my traditional job with my YouTube stuff, because there are many times where I'll learn something, whether it be from a sell side research report we've received, or some other platform we've gotten information from, and that's translated into a video at some point. So I really enjoy that aspect of working in the industry. I still kind of I have fingers on sort of these sources of information. But I think, generally speaking, it depends what you're trying to learn as well. Like I think books are great for learning the basics and teaching yourself financial concepts. I think I'm kind of late getting into it, but the last book I was reading was The Essays of Warren Buffett, which I think is one that a lot of people highlight as sort of a starting point. There's a lot of classics that I'm trying to get through. Classics is my own definition of what I'd call investment classics, but plenty of books as well that I've read, as well as economics books as well. So more broad topics in discussion, but it depends on what kind of information you're looking for. But yeah, plenty of resources out there that free or paid for. So if you want to dip your toes in, I think there's plenty of ways to get around without paying for a service upfront.
You could certainly do worse than reading the thoughts of Warren Buffett. I mean, let's be real.
Sure, yeah, that's right.
One thing I wanted to mention too about your point on analyst research, for those who can get access to it, one thing to keep in mind is that they need to disclose if their firm holds a position in it or what have you. There's regulatory disclosures here. Think back to what that CFA Institute study said. There was only 25% of influencers were even disclosing any kind of conflict of interest at all. So even if they aren't necessarily explicitly saying, hey, I hold this stock and that's why I think this, that, and the other thing about it, they might hold a stock and not mention that, right? So something to keep in mind when you're taking this information. Anyway, let's get to another question here. This one is question number 6, coming from Jason. Let me just pull it up here. How does your approach to evaluating a stock as an investment analyst differ from what you might see on Reddit threads or forums and the like? Good question.
Yeah, so I think how does it differ? Well, it depends on, I think just because there's amateur research out there, and to give credit to some people online, some people do a great job with the research they post on an amateur basis online. And one thing I've recommended to, I speak to a lot of students in finance about entering the workforce. And one thing I always recommend is actually, if they feel comfortable publishing their research online, to get feedback, to better understand the process. So really, it's not to knock any type of person who posts amateur research online. And I think there's a benefit if you highlight, hey, this is my amateur research, rather than saying, hey, this is my expert opinion, or this is my next big pick that's going to blow up in value. I think so long as you're very clear with your level of expertise, I think that's great. I think it's a great way to learn. I think some people post really good research reports online for free on some of these platforms. So, to say that my research is different from Reddit users, it might not be. It depends on what is being highlighted. If you talk about Reddit specifically around, say, Wall Street bets and the like, one thing you typically see is a lot of a heavier focus on technicals, meaning things like stock volume, trading patterns, and buying activity of institutions, short interest. And these are things that don't inherently have to do with the fundamentals of the company, but are just sort of based on where the price of the stock is moving. And it's sort of the school of thought that it sort of believes that everything is baked into a stock's price. Therefore, if you research the stock's price, you can predict where it will go in the future. And there's questionable sort of arguments for whether that, has any validity to it or not. Some technicals can add some value with research, but my own approach is as a fundamental analyst, which means that it's understanding the company, reading through their research filings, referencing research reports, doing some sort of valuation method to try and understand what we're paying for today versus what we think it might be worth, and doing that kind of nitty-gritty dive into the company's operations. So there might be some, well, that's probably the biggest distinction I would highlight, is sort of fundamental research versus more of a technical focus, and admittedly speculative focus on that side of, I saw this big buying activity, therefore I think that's a hedge fund and GameStop's about to blow up in value. But that's only if you're referencing that crowd. I don't think I'd make a blanket judgment to say that everyone on Reddit posts research like that. I've seen examples of great research online.
Yeah, I think it goes back to the earlier point that you had made about, verifying information that you see in one source with other sources to make sure that, there's some consistency there and that you can kind of qualify what you're hearing here. Let's take another question. This one's coming to us from Misha. How much of your own portfolio do you hold in speculative assets?
Well, it depends. I'd say probably, by my definition of speculative, probably zero. If you say speculative like Bitcoin or gold, and you can get into some debates about what speculative means. My view is speculative being where you don't have sort of that fundamental understanding or research or evaluation of the company, and your investment thesis is based on, say, a forecasted or predicted event that there's not much support of. So that would be, say, buying a pharmaceutical company on the hopes that they're about to release a big new drug, or buying off of a rumor or things like that. So that's what I would define as speculating. I don't really invest based off that. So I would say zero. I don't hold any cryptocurrencies. You could have a whole debate there, but it's just not in kind of the field of investments I like to operate within. I like to focus on producing assets rather than assets that just trade in value over time, or that people hope will trend upwards in value. Producing asset being like a company stock that I believe over time will actually generate money, so generate a profit, and that's where its source of return comes from versus just continually rising demand for this object or thing. So that's my preference of investing. So I'd say, yeah, zero or none, but it depends on how you define speculative. There are companies where I guess you could argue I speculate that they'll do better in the future than they do today, because no one really knows what the future is. But it's always based on a fundamental understanding of what the business is, being happy and comfortable with their current operations, and being in it for the long term.
If you're a new investor and you have some appetite to do speculative investing, is there some kind of rule of thumb that they can keep in mind when it comes to how much of a portfolio that kind of asset class might want to make up? Because one of the things that we see from Gen Z investors in particular is that crypto is an outsized portion of what a lot of them are investing in and stuff like that. So like, where is like the rule of thumb of where that should kind of fit into a well-balanced portfolio, let's call it?
Yeah, again, it depends on the situation, but I think, I think the core and satellite, or core and explorer is what some people call it as well, is a good approach with that, as well as even with learning investing. If you want to go through the process of learning how to research stocks, I think it's great to do this sort of core and explore approach where you take the majority of your funds, let's call it 80 or 90% of your money, and you invest it in, say, a managed solution if you are exploring investing analysis or research, and then putting the 10 to 20% and using that bucket to explore these other options. And I think that approach, what it does is it gives you that room to use some of your money to invest where you believe in. And if you want to speculate, I think there's a bit of a gambling risk there, but it's your money and you can do with it as you please. And if you want to do a risk-based approach, you can limit how much it impacts your finances, so that if you are totally off with your speculation, it doesn't sink your entire retirement fund. So I think that's kind of the best way to approach it is, be prudent with the vast majority of your money and give yourself a bit of flexibility if you want, but make it rules-based and set a limit so that you aren't putting your long-term financial goals at risk.
Some investors just have that itch to speculate. They need to scratch it, right?
That's right. Yeah.
I think that's a great rule of thumb that you bring up here. That's all the time that we're going to have for questions. Appreciate you taking a little bit of extra time with us here, Richard. It was a fascinating conversation. Any final thoughts you want to leave our audience with?
I think, like I mentioned earlier, kind of going to the earlier parts of our discussion, when it comes to social media, it's a really incredible tool for learning about investing. I think it's done a great job of improving the freedom of information. But if kind of the biggest takeaway I'd say is just to apply a healthy dose of skepticism and be critical with your sources of information with investing and pretty much any other topic that you come across online. But with investing, because it has such a meaningful consequence for your financial situation, for your lifestyle rather, you have to treat it accordingly. You can have misinformation around other topics, whether it be sports teams and the like, where there's not as much of a consequence, but investing is a very critical area. So you need to treat it accordingly. So it's great. And I encourage everyone to explore and discover the subject of finance and investing, to learn about the basics and get to that point where they're comfortable to hop into the space, but to try and do so as prudently as possible, and to always apply this sort of critical thinking when evaluating sources online.
In other words, be a very conscious consumer of what you see on social media when it comes to investing and trading content. Yeah, well said, Richard. Again, we really appreciate you taking the time. That's all the time we have for today, but really appreciate you taking the time to join us. And for those in our audience, really appreciate you joining as well, too. We hope you had a good time here. Please let us know what you think in our exit survey as well. We love to know what you thought about the presentation, what you think we could do better, and what you want to know more about, too. We're always fascinated to hear. And as well, make sure you can check out some of our upcoming events as well. Investor Education Month isn't over just yet. There's still some time to register for other events and check out some of the past stuff we've had in there. So make sure to click on those links as well. Thank you so much for tuning in. Thank you so much, Richard, for joining us. We will see you all next time.
Thanks for having me on.
Have more questions? Check out the links to the right and in the description below.